Hey, it's Jack from Jack Gately Real Estate and the Online Real Estate Academy. So we had a really interesting jobs report this morning, and let's take a look at the market and where it's been reacting or what's been happening in the market. Dow futures are down. A market's going to be opening up momentarily here. S&P, or it already actually just a few minutes ago, S&P opens flat, heads for its first losing week in 10 following a hot jobs report. So again, a situation where good news is bad news, but the jobs report is very complex, and we're going to get into it in a minute here. Let's just take a look at the headline, which is what almost everyone looks at, but they don't look at the details. U.S. payrolls increased by 216,000 in December, much better than expected. They were expecting a number more like 173,000, something like that. So the headline number is higher than expected, and consequently, your 10-year has jumped up now to be back over 4%. And as we know, the 10-year basically dictates the 30-year mortgage rate, and that's why we're talking about it, because the 30-year mortgage impacts our real estate businesses, of course. And now we're looking at a 10-year, which is back over 4%. You'll remember that it peaked somewhere near 5% back in the middle of October, which corresponded with rates at about 8%. Because there is a spread. And the biggest spread that we had, I think, this year, and all credit to Lance Lambert for digging this number up, but the spread that we had the biggest this year was 330 basis points between the 10-year and the 30-year fixed, as measured by Mortgage News Daily. That spread has fallen recently to about 275-ish points. And we hit a high spread of about 330 in May of this year during the mini banking crisis, or from the wake of the mini banking crisis. And now we're down to something like 275 basis points spread. So that's been compacting a little bit, and that has made rates go down a little bit. But with this hot jobs number, according to the headline, basically, this hot jobs number is saying to us that that the economy is too hot, which means that the likelihood that they're going to cut rates, that's wrong, isn't it? That's better. That the likelihood that they're going to cut rates goes down, and the market doesn't like that. The market wants the rates to go. They're thinking that there's going to be 6 rate cuts, and they're indicating now that that was somewhat irrationally exuberant, right? That they heard what they wanted to hear. And now with this jobs number, that's probably not going to happen. But when you look into the jobs number report, you actually dive down into it. And I think this paragraph here says a lot. Hiring boost came from a gain of 52,000 government jobs and another 38,000 in healthcare related fields, such as ambulatory healthcare services and hospitals. What you have to realize is that a lot of those healthcare jobs are actually government jobs. So basically, the government is driving the jobs number. The government is driving the jobs number. And when you stop and think about that, that is not healthy for an economy. It might be good news if you're trying to get reelected, but it is not healthy when the government is creating most of the jobs, because that means that productive people that actually add value to the economy, they're shrinking. And that's exactly what happens, because when you look at transportation and warehousing, they saw a loss of jobs. And we've seen an increasing number of like low paid jobs in the retail trade, that up by 17,000. But when you're losing your transportation, your warehousing, your kind of like nuts and bolts value added jobs, and your government jobs are conversely going up, that's might be a good headline number, but that's not a healthy thing for the economy. And as real estate agents or brokers, we probably also want to be keeping in mind where is the economy going. And so right now, today, you see rates are going up. Rates are going up. And the economy is maybe not as healthy. It's a really tricky situation. You can't ignore the rate situation. So let's just focus on what the numbers are. And when we're looking at the mortgage rates from yesterday, mortgages ticked in at 676. You would imagine that after today's jobs number, they're probably going to go up, as Mortgage News Daily said. There's a lot at stake with Friday's job report. And with this number being blown away on the top side, that is bad for mortgage rates on the near term. They're probably going to go up, as I predicted, but it's also maybe not as good for the economy as you think, because most of those new jobs being created are from the government. That's not a good situation. I want to bring in Tony Dwyer, who was on CNBC explaining why mortgage rates might continue to go up. Here he is here.
October 7th, you came into the market with rates spiking to 5%, with the S&P historically oversold, with the VIX historically oversold, or overbought, sorry. And the dollar was very strong. And it is absolutely opposite coming into this year from that scenario. So the market is right. It's very positive historically to have the kind of breadth move that we've had that came with the Fed pivot, dovish pivot last year. But all the data that we have suggests it just got too extreme.
What are your thoughts on Treasury yields as we do see the 10-year back at 4% now?
So the technical side of it would suggest a bounce. Like as I said, Morgan, like if you looked at the weekly stochastic, I call it my trusty weekly stochastic. When we look away from the macro or the fundamental data, any move. What's been amazing to me is how extreme the moves have become.
That's a good point. I mean, the move down from close to 5 was extraordinary.
And how quickly they become extreme. So you've gone from an extreme overbought when interest rates on the 10-year got up to 5%, now down at 3 3/4, it got extreme to the bottom side. So it suggests a bounce. Coming into this year, you had the market anticipating 7 rate cuts when we were talking about more,
which was crazy, way over exuberant.
We called it higher for shorter. When rate expectations coming into October were for only maybe 3 cuts this year, it's 7 cuts. You're kind of I don't know what data you're going to come out with this month that's going to make yields go down. So I think that was the setup for a bump higher in yields here. So coming into this year, we called it the first
just way over exuberant. We can see another interview with Bianco here. Let's watch this interview here, unless they play us an ad in the front.
So with more rugged capability, you can take on any road.
But because the market got so far ahead of itself, it almost seems natural that any excuse to drive rates higher is going to happen. So you're going to see the 10-year go back up because statistically it just got overextended. So the ad is over. Let's bring up this interview.
Was there anything out of the minutes that you thought was interesting, especially considering we had a lot of Fed speak after that Fed meeting, which led the markets to really believe that 6 rate cuts were happening next year?
Yeah, no, I thought that Steve did a good job, that the minutes came in a little bit more hawkish, or we might say a little bit more balanced than people had expected, that it wasn't the type of minutes you would have heard if the Fed was getting ready to cut 6 times this year. And so I think on balance, it was suggesting that the Fed might be a little, if I could use the word, stickier in cutting rates. It doesn't mean they won't cut rates. It's just it might not be as aggressive as everybody says. To your first question, yeah, I've been arguing for many, many months that I think that the 10-year yield could go to 5.5%. That has not been working for the last few
Now,
months.
I want you to hear that again. He thinks that the 10-year yield is going to go to 5.5%. That would equate mortgage rates at approximately 8.4 or almost 8.5, depending upon how the spread goes.
But I also see an economy that's doing okay. And I see inflation that might, to use the word again, sticky, around 3%.
But is the economy really doing okay because the jobs numbers are driven by government hiring?
And so I'm going to stick with that I think that, before 2024 is out and probably towards the middle of the year, we might see new highs in yields and maybe closer to 5.5%.
Jim, what is it on the back of inflation reemerging or the economy suddenly surging and reaccelerating to the upside? What does that move higher in yields look like?
No soft landing. I don't think we're having a soft landing. And if I was to stick with the metaphor, I think we're having a no landing. I think that the economy is doing what it does 90% of the time. It is continuing to expand at trend, which about 2.5% growth, or maybe a little bit better. So 2.5% growth. If inflation is bottoming at around 3%, which is roughly where we are now, because demand is going to hold in, you add the two together, you get 5.5%. And that's where I come up with 5.5% for the yield. That's nominal GDP. That the 10-year yield should approximate where nominal GDP is. So where I'm differing from Wall Street's consensus is I don't think we're going to see a slowdown. I don't think we're going to see a soft landing. I think we're just going to continue to see trend growth, or maybe a little bit better than trend growth. And that's basically what we saw in 2023.
Excellent analysis. And he did not mention the other thing that I really think is going to be driving our mortgage rates in the 10-year. And that's a massive amount of borrowing that is going to be coming this spring. Let's listen to the ever wrong Kramer on CNBC.
All started at the same time. Now, I know I say ignore Manhattan, but anybody who wants to see Venice, the Gowanus. The Gowanus, the number of apartments that are being built along the Gowanus, you would think it's the Riviera.
Really?
You really would. I mean, thousands of apartments are coming out. They all start at the same time. And I know that's anecdotal, but believe me, if they're building them around the Gowanus, which, by the way, sometimes is blue, sometimes is green. It's like the river in the movie The Fugitive on St. Patrick's Day. I mean, sometimes it's bubbling. Sequence. I'm always afraid someone's going to be smoking a cigarette while I walk over the bridge.
Yeah, well, the new supply online is definitely a story in the Southeast.
Stay close to that story. People are not talking about the number of apartments that were started after COVID that are now coming on. And they don't talk about it because a lot of them are these private developers. But
I can't take any more, Kramer. So the bottom line is, as a real estate professional, the number one thing you've got to look at is mortgage rates. And a lot of your investor clients might be asking you, Jack, what's going to happen with rates in the springtime? And first off, you have to remind them that we are in 2024, which is going to be kind of a silly season, as I think we can all admit, no matter how you vote. It's going to be a wacky year. But you've got to tell them, I think the market has gotten a little bit ahead of itself with predicting 6 to 7 rate cuts for 2024. That was completely unrealistic. And notwithstanding the fact that the jobs report seems to be padded with a lot of government jobs, most people only look at the headline number. And when you look at the headline number, it seems to be that the economy is running hot, which would indicate that interest rates are going to go back up. Someday, the economy will pay the price for adding so many government jobs, but it just doesn't seem like that's going to be at least right now. All right, I'm Jack from Jack Gately Real Estate and the Online Real Estate Academy. Have a great day. Go make some money. Bye-bye. I can't find the button to shut the live stream off. Oh, there it is. Okay.